Assalamualaikum and hello everyone. My group and I are going to present about capital structure for our FIN544 Advanced Corporate Finance assignment. Capital structure refers to the specific mix of debt and equity that a company uses to finance its overall operations and growth. In the context of FIN544, which focuses on advanced corporate finance, understanding capital structure is crucial as it directly impacts a firm's financial stability and cost of capital. A company's capital structure typically includes long-term debt, short-term debt, common stock, and preferred stock. The balance between these elements determines the firm's risk profile and financial flexibility. Analysts often use the debt-to-equity ratio to assess how aggressively a company is financing its operations through debt, which can indicate potential risk to investors. Determining the optimal capital structure involves finding the right balance that minimizes the company's weighted average cost of capital, WACC, while maximizing its market value. This balance is influenced by various factors, including the firm's operational needs, market conditions, and strategic goals. Before we get started, let me quickly introduce you to my awesome team. I am Siti Norashikin, and together with me is Siti Nur Yohani and Nurul Aiman. We have put together this interesting presentation for all of us to understand capital structure in a more simplified way.
Risk and return strategy. The structure is made of debt and equity, and a company choice of capital structure can affect its financial flexibility, risk position, and ability to raise capital. In the end, it forms of the basic of achieving long-term financial stability and profitability. Next is optimal capital structure is a critical aspect of financial management, ensuring that a company minimizes its cost of capital while maximizing shareholder value. The process is involve a careful evaluation of various factors to strike a balance between debt and equity financing. How to determine the optimal capital structure? First of all, it is necessary to determine the cost of capital and in particular the weighted average cost of capital, the WACC. The WACC presents a general picture of the cost of financing, including the cost of equity and the tax cost of debt. Firms prefer low WACC because lowering the cost of capital increases the company value and it makes it more attractive to the investor. Next is the risk and financial flexibility of the firm must be analyzed. High level of debt increase the financial risk, and this is because of the fixed interest charges. The company have to consider how well they can generate cash in the future to meet this obligation, especially in a bad economy. Next is industry standard also follow their very industry-related trend when determine its come to capital structure in order to maintain the competitive of the company. For instance, company in the utility section, which have a relatively low asset risk, tend to have a higher debt level than company in the technology sector, which prefer to stay liquid to find new innovation. Another factor is the firm profitability and cash flow stability. The ability to generate cash flow and earn points constantly make a company a good candidate to assume more debt since its income is relatively steady and there is less chance of the company defaulting on the debt. On the other hand, firm with unpredictable earning may decide to raise equity capital to reduce the risk of financial distress. And lastly, the main advantage of debt financing is the tax benefit of interest payment, which reduce taxable income. However, the company must consider the potential cost of high level of debt, including the likelihood of bankruptcy and restricted operating capacity. A firm capital structure is influenced by a variety of internal and
What is financial distress? Do you know what are the signs of financial distress? Recognizing these signs early can help in taking corrective actions to prevent further financial deterioration. Let me share with you the three signs of financial distress. Firstly, negative cash flow, consistently spending more money than is being earned. Second is declining sales, a steady drop in sales or revenue over time. And the last one is increasing debt, growing reliance on borrowing to cover expenses. More signs of financial distress? Sure, let's dive in. Fourth one is inability to pay bills, where you struggle to meet financial obligations on time. Number five is low employee morale, reducing productivity and morale among employees due to financial instability. The sixth one is asset liquidation, selling of assets to generate cash. Let's keep going. Number seven is quite important. Credit issues, which causes difficulties in securing new financing or worsening credit terms. And last one is legal trouble, where you face lawsuits or legal actions due to unpaid debts. You may be wondering what causes financial distress. Let's discuss more on this. Financial distress can be caused by various factors for both organizations and individuals. For organizations, it may be due to high fixed costs, when significant ongoing expenses that do not vary with production levels. Secondly, the economic downturns, which can reduce consumer spending, and economic stagnation may impact revenues. Third one is when high levels of debt become unmanageable, especially if income decreases, it causes excessive debt, which can cause financial distress. Now, how about individual? Let me share some of the causes that can cause financial distress for individuals. It can happen when we have issues with poor budgeting. For example, inadequate financial planning and overspending. And then all those unexpected medical bills that strain your finances. This will be a huge burden for individuals. Lastly, if an individual loses their job, it can lead to significant reductions in their income. Recovering from financial distress involves a combination of strategic planning, discipline, execution, and sometimes seeking external help. For organizations, firstly is to assess the situation. This can be done by conducting a thorough financial analysis to understand the extent of distress. Second, organizations can opt for debt restructuring. Negotiate with creditors to restructure debt terms, potentially lowering interest rates or extending repayment periods. Organizations can also try to increase their revenue by exploring new strategy, improving sales targets, and enhancing marketing effectiveness. However, for individuals, on the other hand, most importantly, is to reduce expenses like cutting back on non essential spending and finding ways to save unnecessary expenses. Other than that, debt management is very crucial. Prioritize paying off high interest debts first and consider debt consolidation if it helps to manage payments better. And most importantly, is start building emergency funds. Save a portion of your income to create an emergency fund for unexpected expenses. The integration of tax effects and financial cost distress is a crucial concept in corporate finance, particularly in determining a firm's optimal capital structure. When a firm uses debt financing, it can deduct interest payments on debts from its taxable income, creating a tax shield. This tax shield effectively reduces the firm's tax liability, increasing its after tax cash flow and overall value. The more debt a firm uses, the greater the tax shield up to a certain point. However, increasing debt also raises the risk of financial distress. Financial distress costs include both direct costs such as legal and administrative expenses during bankruptcy and indirect costs such as loss of customers, suppliers, and employee morale. These costs can significantly reduce the firm's value. What is agency cost of equity? The agency cost of equity arises from conflicts of interest between shareholders and management. These costs occur because management may not always act in the best interest of shareholders. Effectively managing these agency costs ensure that management actions align with shareholders' interests, ultimately enhancing the company's value. There are two types of costs: direct costs and indirect costs. Direct costs expenses related to monitoring and controlling management actions, such as audit fees, while indirect costs losses from suboptimal decisions by management, like avoiding profitable projects or engaging in unnecessary expansions.
Assalamualaikum sir, my name is Siti Nur Yohani binti Azman and I will explain about the pecking order theory. So pecking order theory is a corporate finance theory that explains how companies prioritize their source of financing. So these theories were actually popularized by Stewart Myers and Nicholas Majloof in 1984. So from pecking order theories, I'm going to jump and explain about the asymmetric information. What is asymmetric information? Asymmetric information is where managers have better knowledge about the company financial situation other than outside investor, making equity financing more costly due to higher risk. So how does asymmetric information impact pecking order theory? It occurs when one party has more information than the others and potentially costs are inefficient due to the market failures. Okay, let's take an example for the asymmetric informations. So for my example here, we have seller advantage and also buyer advantage. So in a used car sale, the seller know more about the car condition than the buyer. However, the buyer advantage, the health insurance, the buyer may know more about their health risk than the issuer. So that is the example for asymmetric information. Okay, next I will explain about signaling hypothesis. So a signaling hypothesis is actually a theory in corporate finance that suggests companies use certain actions to signal their private information to the market. So this theory particularly relevant in the context of dividend policy and capital structures decisions. So how the dividend signaling work? If the dividend increase, it signals that management's expectations of strong future earnings and cash flows, indicating that only firms with positive prospect can maintain higher payouts. While if the dividend decrease, conversely, a reduction in dividend may signal potential financial difficulties or lower future earnings. Okay, last I will explain about the capital structure signaling. So we have the debt issuance and also equity issuance. So for the debt issuance, issuing debts actually suggesting management confidence in the company ability to generate cash flow for interest and principal repayments, indicating the potential undervaluation and future promise. Meanwhile, the equity issuance actually indicate that management perceive that company stock as overvalued and potentially resulting in a negative reaction to the market. That's all from us. Thank you, sir.
In conclusion, the capital structure of a company is a fundamental aspect of its financial strategy, influencing both its risk profile and cost of capital. By carefully balancing debt and equity, Firms can optimize their weighted average cost of capital, WACC, and enhance their market value. Understanding the nuances of capital structure, as explored in FIN 544, equips financial managers with the tools to make informed decisions that align with the company's strategic goals and market conditions. Ultimately, a well structured capital framework supports sustainable growth and financial stability. Thank you so much for watching, and we hope you enjoyed the journey. Bye.